Have you ever wondered what happens when the smartest investors in the world start getting nervous? Not on television, not on social media, but with their money. Long before economic problems appear in headlines, financial markets often detect them first. And among all financial markets, one stands above the rest when it comes to warning signals. The bond market. For decades, investors have called it the smartest market in the world because it reacts directly to economic reality rather than excitement and speculation. Today, according to concerns frequently discussed by Ray Dalio and other major investors, the bond market may be sending a signal that many Americans are ignoring. The question is simple. What exactly is it trying to tell us? Most people pay attention to the stock market. They watch indexes rise and fall and assume that stocks reflect the health of the economy. But the bond market is much larger and often more influential. Governments borrow through bonds. Corporations borrow through bonds. Pension funds invest in bonds. Insurance companies depend on bonds. Central banks monitor bonds. In many ways, bonds sit at the center of the global financial system. When the bond market becomes unstable, the consequences can spread throughout the economy. To understand the warning, we first need to understand what bonds actually are. A bond is essentially a loan. Investors lend money to a government or company in exchange for interest payments. When investors feel confident, they are willing to lend money at lower interest rates. When they become worried about inflation, debt, or financial stability, they demand higher interest rates as compensation for greater risk. That is where today's concern begins. Over the past several years, government debt has grown dramatically. The United States already carries one of the largest debt burdens in its history. Every year, new borrowing is added on top of existing obligations. While debt itself is not necessarily dangerous, problems emerge when debt grows faster than the economy's ability to support it. Investors begin asking difficult questions. Who will buy all this debt? How much interest will need to be paid? What happens if borrowing costs continue rising? This is where the bond market starts flashing warning signs. As debt increases, governments must issue more bonds to finance spending. That means investors must absorb larger and larger amounts of new debt. If demand remains strong, borrowing costs stay manageable. But if investors begin demanding higher yields before purchasing bonds, the cost of financing government debt rises significantly. Ray Dalio has often explained that debt cycles are among the most important forces driving economic outcomes. In the early stages of a debt cycle, borrowing stimulates growth. Money flows through the economy. Spending rises. Businesses expand. Asset prices increase. But eventually debt reaches levels where the system becomes more fragile. At that point, even small changes in interest rates can have enormous consequences. One reason the bond market matters so much is because it influences almost every other interest rate in the economy. Mortgage rates, business loans, credit cards, auto loans, and many other borrowing costs are connected directly or indirectly to bond yields. When bond yields rise, borrowing becomes more expensive throughout the financial system. Consumers feel it, businesses feel it, governments feel it. Imagine a family trying to purchase a home. A small increase in mortgage rates can dramatically change monthly payments. Suddenly a house that seemed affordable becomes out of reach. Demand weakens. Housing activity slows. Construction slows. Related industries begin feeling pressure. What started as a movement in the bond market eventually affects millions of people. Businesses face similar challenges. Companies rely on borrowing to expand operations, build facilities, hire workers, and invest in future growth. Higher borrowing costs force executives to reconsider expansion plans. Some projects become unprofitable. Hiring slows. Investments are postponed. Economic growth begins losing momentum. The danger becomes even greater when governments face rising interest expenses. As debt grows larger, even modest increases in interest rates can dramatically increase annual interest payments. Money that could have been used for infrastructure, education, healthcare, or other priorities must instead be directed towards servicing debt. Over time, this limits financial flexibility and creates difficult policy choices. Many investors believe the bond market's current message revolves around sustainability. Investors are asking whether governments can continue borrowing at the same pace indefinitely. They are evaluating inflation risks, fiscal deficits, economic growth prospects, and future monetary policy. The answers to these questions determine how much confidence investors have in long-term government debt. Inflation plays a central role in this story. Bond investors hate inflation because it reduces the future purchasing power of fixed interest payments. If inflation remains elevated, investors demand higher yields to compensate for that loss. This creates a difficult challenge for policymakers. Lower rates can stimulate growth, but inflation concerns may prevent rates from falling as quickly as markets would like. Another reason the bond market signal matters is because it affects asset valuations across the economy. Stocks, real estate, private equity investments, and many other assets are influenced by interest rates. When rates rise, future cash flows become less valuable in present terms. Valuations can come under pressure. Markets that previously seemed unstoppable may suddenly encounter resistance. Ray Dalio frequently emphasizes that financial systems operate through interconnected relationships. No market exists in isolation. Rising bond yields influence government finances. Government finances influence economic growth. Economic growth affects corporate profits. Corporate profits affect stock prices. Everything connects. That is why bond market movements often carry implications far beyond fixed income investing. History offers numerous examples of bond markets identifying problems before they became obvious to the public. In several past economic slowdowns, bond yields shifted significantly before recessions officially began. Investors recognized deteriorating conditions early and adjusted accordingly. By the time headlines caught up, markets had already moved. Today, some analysts argue that the bond market is signaling concern about the sheer scale of future borrowing requirements, demographic pressures, entitlement obligations, infrastructure spending, and interest expenses all point toward continued borrowing needs. Investors are evaluating whether future demand for government debt will remain strong enough to absorb this supply without requiring significantly higher yields. Foreign demand represents another important factor. For decades, international investors purchased large quantities of U.S. government bonds. This helped keep borrowing costs relatively low. However, global financial dynamics are changing. Different countries are diversifying reserves. Geopolitical tensions are increasing. Economic priorities are shifting. Even small changes in foreign demand can have meaningful effects on bond markets. At the same time, central banks are no longer playing the same role they did during previous periods of financial stress. In the past, aggressive bond purchases helped support markets and suppress yields. Today, policymakers must balance growth concerns against inflation risks. Their ability to intervene may be more limited than many investors expect. One of the most important concepts in Dalio's framework is the balance between debt creation and productivity growth. Debt can support growth when borrowed money generates future economic value, but if debt grows substantially faster than productivity, the long-term burden increases. Eventually, investors begin questioning whether growth will be sufficient to support future obligations. The bond market appears highly sensitive to this issue because debt levels have expanded significantly, while long-term growth expectations remain relatively modest. Investors are effectively asking whether future economic output can justify current borrowing trajectories. The answer to that question influences every aspect of bond pricing. For ordinary Americans, These discussions may sound distant and technical, but the effects are surprisingly personal. Rising yields can increase mortgage payments, reduce housing affordability, pressure retirement portfolios, slow wage growth, and create economic uncertainty. What happens in the bond market eventually reaches Main Street. Consumer spending often feels the impact as well. When borrowing costs rise and asset values face pressure, households become more cautious. Large purchases are delayed. Savings rates increase. Confidence weakens. Since consumer spending drives a substantial portion of economic activity, even small behavioral changes can produce significant effects. Investors face difficult decisions in this environment. Some seek safety, others pursue diversification. Many focus on understanding long-term trends rather than reacting to short-term headlines. The key challenge is distinguishing temporary volatility from structural change. Not every market movement signals a crisis, but some signals deserve careful attention. The phrase dangerous signal does not necessarily mean an immediate collapse is coming. Markets rarely operate in such simple terms. Instead, it suggests that underlying conditions may be becoming less favorable than they appear on the surface. The bond market often highlights vulnerabilities long before they become obvious elsewhere. This is why experienced investors pay such close attention to yields, debt levels, and borrowing costs. They understand that these variables influence the entire financial system. A rising yield is not merely a number on a screen. It reflects expectations about inflation, growth, risk, and confidence. America remains one of the strongest economies in the world. It continues to attract investment, innovation, and talent from around the globe. But strength does not eliminate risk. Every major economy must confront challenges related to debt, demographics, productivity, and fiscal sustainability. Ignoring those challenges does not make them disappear. The bond market's message today appears to be one of caution rather than panic. Investors are demanding greater compensation for risk. They are watching debt levels closely. They are evaluating long-term sustainability. They are asking questions that policymakers, businesses, and citizens may eventually need to answer. And that may be the most important lesson of all. Financial crises rarely emerge without warning. The signals are often visible long before the headlines arrive. The bond market has earned its reputation because it tends to focus on fundamentals rather than emotions. Whether its current warning proves correct remains to be seen. But if Ray Dalio's analysis of debt cycles has taught investors anything, it is that ignoring the bond market has rarely been a successful strategy. When the world's largest and most influential market begins sending a message, it is usually worth listening.